Are markets getting ahead of themselves in terms of pricing in this aggressive cycle of tightening now?
Look, we think they are compared to our own forecasts, and we have one of the more hawkish forecasts across the forecasters, where we're expecting the Reserve Bank to tighten policy, as in lift the cash rate at the end of next year. A lot of other forecasters don't have the Reserve Bank hiking until 2023. Markets, though, on the other hand, have moved quite aggressively over the past couple of weeks, and I think they've got ahead of themselves. I mean, the central bank here is still a very patient one in terms of normalising the cash rate. They've got a pretty high hurdle to raise interest rates. They want to see inflation, and this is in their words, sustainably around the midpoint of the target band, so that's around 2.5% for a couple of quarters, be confident that wages growth is also accelerating, and only then will they lift the cash rate. So we think that won't happen until the end of next year.
I'm just going to bring up this chart, which our viewers will be able to see. This is the April 2024 note, which saw most of the action this week. Going into the RBA meeting next week, does this potentially change what you expect from them in policy guidance? And do you expect intervention at some point, even though they've refrained so far?
Look, it's a hard one. In a lot of ways, it was all about what they didn't do yesterday rather than what they did do. And what they didn't do was actually step in to defend that yield curve target. And that's why the money market sold off pretty aggressively. And it's left a lot of people now unsure as to what the Reserve Bank's intention is with the yield curve target. In the note that we put out yesterday, we said explicitly that there's a key risk here that they just abandon the yield curve target at the November board meeting. If it turns out to be the case that they have to upwardly revise their inflation forecast in a way that means the 2024 mantra, which is really what the yield curve is all about. It's about their conditional forward guidance where they don't think conditions will be met to raise the cash rate until 2024. Well, if they have an inflation profile that's no longer consistent with that, then they could well just walk away from the yield curve target. They can't. Until that board meeting, they've still got the yield curve target there, but I think markets are really on edge now as to what they might do over the next few days heading into that very important board meeting.
What are the market implications in terms of the Aussie dollar and the equity markets as well when you have these very dramatic moves in the fixed income space?
Well, look, all markets are obviously affected. I mean, the equity market less so, and the currency bounces around as the market is trying to price in these hikes. But I think it's all been about the money markets at the moment, because when you think about yield curve, the target and what the bank has been trying to do, they've been trying to suppress interest rates at the short end, artificially suppress them, if you like, because they've been trying to make the case that they don't think they'll be raising the cash rate for many, many years. And the markets just don't believe them at the moment. And the fact that they didn't step in and do anything yesterday has really got everyone a little bit on edge. And I think if they don't do anything today, then they're going to do something about that yield curve target next week. I mean, we've been making the case basically all year that this yield curve target was going to prove problematic at some stage. And around the middle of the year, the Reserve Bank decided to stick that target, peg it to the November 24, to the April 24 bond rather, and it basically went from 3-year yield curve control to targeting a particular bond. But we were always of the view that the moment that the markets thought that the Reserve Bank would be moving earlier, and we get a few upside surprises on CPI, and we had one this week, then it's going to cause some real problems, and that's where we're at today.
Talking about CPI, when it comes to the yield curve control, that's a really lower hurdle than raising the cash rate, as you said, right? So what is the inflation forecast right now that makes you believe that the cash rate will still be on hold for a while?
Yep, so we've only had one print really that you would say is a strong print, and that came through this week where the core read lifted by 0.7% over the quarter. The consensus was around 0.5%, and the RBA's implied profile was for 0.4%. So a genuine upside surprise there. But we've only had one upside surprise, and that took the core read to 2.1%. So we think it'll take a few more prints of around sort of 0.6%, 0.7% to get inflation up to around the midpoint of the target band. But that in and of itself won't be sufficient for the Reserve Bank to raise the cash rate. They'll want to be sure that wages growth is heading upwards. And I think that's a key difference between Australia here at the moment and a lot of other countries around the world. We have not yet seen in our official data wages start to head
Right.
north. We think it'll happen, but it hasn't happened yet, and that's what gives the central bank some time. They've got to really see two things: inflation moving higher, be confident it's going to stay there, and the way they will be confident it will stay there is if they see wages also moving higher. We think that'll happen next year, and a key
Yep.
sort of logic underpinning that is that higher actual inflation is going to make it easier for people to get a lift in wages, because they'll
Right.
point to actual inflation, say, look, inflation's 2.5%. I should be getting at least 2.5% in terms of wages growth. Otherwise, I'm going
Gareth.
backwards. So we think that whole process will take off next year. It just takes a little bit of time.